Okay, guys. Now we can move to our next part, growth rate. For your examination purpose, growth rate calculation of growth rate is not important. Okay, but I decided to do this growth rate calculation part because of I think I think understand of growth rate is more beneficial for you to attend the valuation question as well. There is one point that we need to use growth rate under valuation, but it is not about this growth rate. I will talk about it later. Somehow I decided to do growth rate calculation part or the identification of growth rate as the part of my video tutorial series. Then actually growth rate is important when we forecast our financially stable. For forecasting purposes, it is more important. In growth rate, we need to identify revenue growth, net income growth, our expenses growth, earning pressure. So growth, we should have idea about our growth, our revenue growth, as well as the net income growth, share growth, whatever. Then there is many things that we need to know for the forecasting purposes. Okay. Then from this part, I am covering mainly identification and calculation growth rate for our valuation purpose. Okay. Then for that purpose, one method or the one way that we can identify our growth rate based on our historical trend. That means we can use our historical growth as our forecast. We can use our historical growth for our forecasting purposes, with assuming historical growth remaining unchanged for the remaining constant for our future forecasting period. With that assumptions, we can use our historical growth. Then for that purpose, based on the historical data, we should identify our growth rate. Then for that purpose, we have several methods. Then one method is the arithmetic average. It's the simplest. We can say simplest method that we can use to identify the growth rate, arithmetic average. Then from arithmetic average, simply we calculate the growth rate of revenue, EBITDA, net income, whatever. We calculate the growth rate based on the average of historical data. We calculate it based on the average of historical information, so the historical data. That means then let's discuss it using some hypothetical scenario. Then here you can see we have details for from 2018 to 2023. Then we have details for 6 years. Then we have the revenue figure. Then first let's only focus on this revenue figure. Okay. Then revenue figure, we have details for the revenue figure 22, 27, 27, 29, 29, and 30. Then we need to calculate uh, arithmetic average or the growth of the revenue based on the arithmetic average, and based on these given historical data, then we need to calculate arithmetic average growth. Then as I told you, we calculate arithmetic average based on the what? Based on the average of historical data. Then for that purpose, first we should calculate each year revenue growth separately. That means for 2019, we need to calculate growth. For 2020, we need to calculate growth. 2021, we need to calculate growth. 22, like this. For each year, we need to calculate each year growth. First, we need to calculate each year growth. Then for 2019, we can calculate the growth of 2019. How can we calculate? 2019 revenue divided by 2018 revenue minus 1. This is simplest way that we can calculate the each year growth. Okay, like this we can calculate 2019 growth. Then how can we calculate it? 2019 revenue divided by 2018 revenue and minus 1. Then we can get our year over year change, or the year each year year over year change for the 2019 as 21.54. Like this we can calculate revenue growth for other years as well. Then for 2020, 3.46, 2021, 6.51. Then 2022, we have negative growth 1.33, and 2023, 5.21. Then like this, first we need to calculate what? Each year revenue growth. Then average of these growth rates, each year growth rates, average of these each year growth rates, we can consider as our arithmetic average growth. Then we need to calculate what? Average of all of these growth rate, average of all of these growth rate. Then this 7.08, we can say as our what? Then this 7.08, we can say as our arithmetic average growth. That means for the forecasting purposes, we can say our revenue will grow at 7.08% rate. That's simplest way. Okay. Then based on the historical trends, we assume historical trend remain unchanged for the forecasting period, and with that we use the 7.08 as our revenue growth rate for our forecasting purposes. Okay, then like same as the revenue, then for the EBITDA, operating income, as well as for the net income, we can calculate arithmetic average. Then as I told you, first we need to calculate each year year-over-year growth, like this, each year year-over-year growth. Then average of these year-over-year growth rate, we can consider as our what? Arithmetic average. Then for the EBITDA, then it is 10.76. Then for the operating income, you can see it is a 47.45. And for the net income, it's a 36.93. Like this, we can calculate arithmetic average for revenue, EBITDA, operating income, and the net income. Okay, this is the, we can say, the simplest method that we can use for the identify the growth. But from this arithmetic average, it is not considered the compounding effect. Okay. Therefore, to overcome this issue, we can use this geometric average to overcome that compounding effect. Because from this arithmetic average, simply we calculate the growth rate based on the historical average. But from arithmetic average, we don't consider the compounding effect. Therefore, we need to overcome this issue. For that purpose, we can use geometric average. Then geometric average, then how can we calculate? Under the geometric average, how can we calculate the growth rate? Simply, under the geometric average, we can calculate the growth rate. How can we calculate? Latest year, let's say latest year revenue divided by last or the end year revenue, latest year revenue or whatever, latest year figure, okay, given figure, it can be operating income, EBIT or whatever, latest year revenue, latest year figure divided by end year. That means last year, not last year, end year. Then for these given details, we can say latest year revenue figure as this one. No, this is our latest year revenue figure. Then what is the last one? Then based on the given details, then last one is this one. No, 22. Then simply this 30 divided by 22, and we need to get power over 1 divided by, first I write formula. Okay, power over, we need to get power over 1 divided by number of years. 1 divided by number of years, and from this we need to deduct. Then we can get the geometric average. From this formula, we can account the compounding effect, and we can get more accurate answer. Okay, then latest year revenue, that means latest figure divided by end year figure, and we need to get power over 1 divided by number of years and minus 1 number of years. Okay, this is the way that we can use to calculate geometric average using this formula. Then here, let's see how can we calculate geometric average for the revenue. Then as I told you, latest year revenue divided by end year revenue, and we need to get power over 1 divided by number of years and minus 1. Then for the revenue, our latest revenue figure is how much? 3931 divided by end year, based on the given details. Our end year one is 22, 245 and power over number of years. Then here, how can we decide the number of years? If it is okay, if I take 6 years, then 6, 2018, 19, 20, 21, 22, 23. There are details for 6 years. No? If I take 6 years, it is okay. No. Is it okay? No, it is not okay. Okay. Because this 22 means we can say as the beginning balance as at 2019 and 2000 end of the 2023 balance is 30. Then from 2019 beginning to the end of 2023, there is 5 years. 5 years. Okay. Therefore, we need to use 5 years here, not 6. Okay, not 6. Then minus 1 from this entire calculation. Then we can get the geometric average for the revenue. Okay, this is the way that we can calculate the geometric average. Geometric average. Okay, then for here, then we can calculate our geometric average. Our latest year revenue 30 divided by 30 divided by 22 and power over 1 5 minus 1. Then we can say our geometric average growth as 6 point. We can say it as the 6.82. 6.82. Then like this, we can calculate geometric average for the revenue. Actually, the amount that we get from the arithmetic average and geometric average completely different. Okay, because these methods are completely different two methods. From arithmetic average, we can get it as 7.08. From geometric average, we can get it as 6.82. Then same for the EBITDA, we can calculate 5.39. Then how can we get it? Latest EBITDA 5,398 divided by 2019 revenue figure of 4151 and power over 1.5. Also, we need to take 5 years and minus 1. Then we can get our geometric average for the EBITDA as 5.39. Then same for the operating income, we can get it as 4.31. And for the net income, we can get as the minus 12.13. Minus 12.13. Like this, we can get the growth rate based on the geometric average. Geometric average. Okay. Then these two methods simply we can use to, as I told you, identify the our future growth rates based on the historical trend. But you can see here, here you can see then under the arithmetic average, then for the revenue and EBITDA, it is 7.8, 10.76, and geometric average is also same. There is no issue whatever if we use arithmetic average growth or the geometric average growth, because geometric average, because both methods are same figures we can go to. But you can see here under the operating income and net income, then from arithmetic average for the operating income, we got 47.45 growth. Actually, this is abnormal, no? Because for the forecasting purposes, can we use 42.45 as our growth? No, we can't do that, because for the small firm, this growth might be okay. This growth might be okay. 42.45 growth revenue operating income. But for the high scale organization, this is not practical. Okay. Therefore, if we use 42.45 as our growth, no, we can't use that. Okay. But you can say from arithmetic average, if from arithmetic average is 42, but from geometric average, you can say it is a 4.31. Okay. From geometric average to 4.31. Yeah, then this one, yeah, it's okay. No, it is a reasonable. Therefore, we can use this 4.31 as our growth rate. Then same for the then net income. You can see actually for the net income, you can see there is high volatility, no? Because you can see it is volatile. Then for the 2018 is 1.5, but when we come to 2023, it is 800 something. Then it is completely reduced, no? It is significantly reduced. Therefore, our geometric average we got as minus negative, minus 12.13. But you can see from arithmetic average, it's so we got as 36.93. Then again, there is issue of using this both arithmetic average and geometric average, because from arithmetic average it is 36.93 again. Then increase net income, increase in net income 36.93. It is abnormal. Okay, it is abnormal. Then also, then you can see then minus 12.13 is also not okay to use, because negative growth. But whatever the situation, any firm, any under any condition, any firm, they try to increase their net income. No, because we can't say their net income will might be minus 12.16. Yeah, we can't say like this. Okay. Therefore, then using both arithmetic average and geometric average is questionable under some situations. Okay. Under some situations. Therefore, there is another two methods. There is another two methods that we can use to identify the growth rate based on our historical data. That means we can link our data to the regression. Then using regression model, we can derive some regression output, and based on regression output, we can develop some formula, regression formula. Then using this regression formula, we can identify our growth rate. Then for that purpose, we have two model, linear and log linear model of growth. Then from linear model, simply from linear model, we run the regression model based on the given data, based on the raw data. And from that, we try to identify the relationship between the given detail. Then here we have detail for earning per share. Here we have detail for earnings per share. Then we try to identify the relationship with earning per share with the year. Then here, 2018 we consider as a year 1, year 2, year 3, year 4, year 5, year 6, year 7. Like this, we try to identify relationship with and if 1 year increase, then what happened to our earning per share? If we want another 1 year increase, what happened to our earning per share? Like this, we try to identify the relationship using the regression. Okay, then we can run regression model using this data. Then here, simply we identify our y-axis as the year, and earning per share we consider as our x. Then using this, here you can see here you can see here using regression model, actually using this data, I'll run another regression model. Okay, then this is the regression model that I run, and based on this regression model, I develop this formula. Earning per share at t refer to the year, equal to 10.79 plus 1.75 multiplied it by t. That means if I need to identify the earning per share for second year, then how can we calculate it? Earning per share for second year, 10.79 plus 1.75 multiplied it by 2. Then we can get the earning per share for our year 2. Like this, for the 10th year, 20th year, like this, for any year, we can identify the earning per share based on this regression formula. Then we develop it using the regression model. Okay, then main thing is, actually we don't need to identify the earnings per share for each year. Main thing is we need to identify what? We need to identify growth rate. We need to identify the growth rate. Then how can we identify the growth rate based on these historical data and based on this regression formula? Then simply we can calculate our growth rate. Here, this slope, then 1.75, we can say it as our slope, no? Then slope divided by average earning per share for the historical period. Slope divided by average earning per share for the historical period. Then simply we can calculate what? Then simply we can calculate the what? Our growth rate. We can calculate the growth rate. Then here our slope is 1.75. Here our slope is 1.75, and we can divide it by the average earning per share. That means we need to take average of all of these from year 1 to year 7. We need to take what? Average. We need to take average. Then we can get average of these figure as this 17.79. We can take our average as the 17.79. Then 1.75 divided by 17.79. Slope divided by average earning per share. Slope divided by average earning per share. Then we can get growth rate. Then 1.75 divided by 70.79. Then we can get our growth rate of earning per share as the 9.84. We can get it as 9.84%. That means we can say our growth rate of the earning per share EPS as 9.84 based on the linear regression model. Okay, I think rather than using the arithmetic average and geometric average, this linear regression model, we can say it as the more accurate way, because regression model means it try to identify a relationship between two variables, y and x. Therefore, this linear regression model, I think it is better to use to identify the growth rate for the forecasting purposes. Okay, then from linear regression model as well as from log linear regression. Actually, from log linear regression model, I hope some of you have idea. We can develop a regression model based on the log value of these periods. That means we have each earning per share. First, we need to run. We need to identify log value of this earning per share, and based on this log value, we can run a regression model. We can run the regression model, and also we can develop regression formula based on that model. Then if we have like this, or if we develop like this regression model, actually we don't need to calculate our growth rate. This slope of this linear regression model directly represent our growth. Then here 9.8, 9.08. This 9.08 directly we can say as our what? Directly we can say as our growth rate. If we run the log linear regression model, then slope of that formula directly we can say as our what? Directly we can say as our growth rate. Okay, then I think rather than using arithmetic average, practically also rather than using the arithmetic and geometric average, this linear and log linear growth models are more better and more accurate. Okay, but we can't say these are 100% accurate, because regression model also try to identify some relationship based on the y and x data access. Okay, try to identify relationship between y and x. Therefore, we can't say this as 100% accurate, but rather than the arithmetic and the geometric average, I think these two methods are more accurate methods. Okay, then these four methods, actually we discussed the four methods, arithmetic, geometric, linear, and log linear models. Then all of those methods are we use based on the historical data. But then use of the historical growth rate for forecasting purposes, there is some issue. One is the simply we can identify the revenue growth, no issue. We can say historical trend of the revenue can be remain unchanged for the future forecasting period. It is okay. But for the earning forecast, for the earning growth, we can't say exactly historical growth remain unchanged for the forecasting periods, because it can be changed when the variance reason due to the inflation, due to the other economic condition. As well, if the country corporate tax rate increase, then it can also directly affect to the earning growth. Okay, therefore we can't say historical growth remain unchanged for the forecasting period for the earning growth, but revenue growth, it is okay. We can say if it is a growing firm, yeah, future trends can be remain unchanged for the future forecasting period. That's the one issue. Another thing is the effect of the firm size. I have mentioned this one also, effect of the firm size. Then here you can see from arithmetic average for the operating income, we identify their revenue as a 42.45. We identify 42.45 growth of operating income. Is it achievable? can we achieve like this growth 42.45? No, it is not practical. Okay, especially for the large scale business. Let's assume like Nestle, like Unilever, like this business organization. Is it achievable? No, because it is nearly 50% growth within year. It is not practical to achieve 50% growth. But for the small firm, yeah, like uh, the revenue, then we can say like revenue and 10 million or 20 million earn in firms, yeah, it is okay because they can grow their revenue because it is a small. They are working, currently they are uh, operating in small scale. Therefore, it is okay to achieve like this growth. But for the high scale, no, it is not practical. Okay, that's the another reason that we can identify the reason to that we can say usefulness of this historical growth rate. Okay, then therefore we can use actually if we don't have any method to identify the growth rate, then we can use historical growth for our forecasting purposes. And rather than using the historical growth, we can use the fundamental determination of growth. That means simply predicted growth. We can predict our growth based on few factors. Okay, then we can predict growth in earning per share. Actually, as I told you, the revenue growth using the historical trend or the historical data, it is okay to uh, forecast the revenue growth. But for the earning, like earning per share, for the net income, it is not okay to develop or okay to identify the growth based on the historical data. Then, for that purpose, we can use several methods to identify the growth in earning per share and the growth in revenue. Okay, here, first let's see how can we identify the growth in earning per share based on our fundamental, business fundamental. Actually, if we assume our main fund source or the if we assume our main fund source method is equity or the equity related fund source, only we use the equity related fund source, then our growth in earning per share depend on main two factors. One is our retention ratio, other thing is our ROE. The retention ratio means what? Retention ratio means the uh, total profit that we retain with the business without distribution to our shareholders. That means from our net profit, then normally from our 100% net profit, we don't distribute our shareholders as dividends. We retain something with us. Then this we can say as our retention ratio. We can say as our retention ratio. Okay. Then this retention ratio is mainly it is mainly affected on the growth in earning per shares because if we retain something with us, then again we can reinvest those things in these things into our business. So then if we reinvest, then we can increase our revenue. Then indirectly, it will affect on what? Earning per share. Therefore, retention ratio, it is directly affected on our growth in earning per share. Another thing is the ROE, return on equity. Then simply, actually, growth in earning per share, we can calculate retention ratio multiplied by the ROE. Then we can use B. Normally, we use B as the retention ratio. B multiplied by ROE. Then we can calculate what? Growth in earning per share. Simply, we can get the growth in earning per share rather than using the historical trend because for the earning per share, it is not practical to use historical trend. Therefore, based on this fundamental, based on the retention ratio and ROE, we can predict our growth in earning per share. And also, growth in net income, then earning growth in net earning per share and the growth in net income, these are completely different two concepts. Then growth in net income, it is depend on the reinvestment and the ROE. It is depend on the reinvestment and the ROE. Then reinvestment mean how much that we reinvestment from our from our earning during the earning. Then let's assume if we earn 1,000, we reinvest 100 into our business, then we can say our retention ratio as a 10, sorry, reinvestment ratio as a 10%. Then reinvestment ratio is directly impact on our net income because our earning capacity and capability directly affected on our reinvestment. Investment in capacity investment and investment in working capital, those things directly impact on our earning capacity. Then if our earning capacity can increase, then definitely we can increase our net income. Okay, therefore reinvestment ratio is also affected on our net income. Therefore, reinvestment ratio, if we multiply it by ROE, then we can get what? Growth in net income. We can get the growth in net income. Okay. Then these two fundamentals we can use to identify the growth in earnings per share and the growth in net income. But I think for your examination purpose, you don't need to know about deeply about these concepts. Okay. Then if you need to know about deeply about these concepts, you can refer to the Ashwat Damodaran valuation book. Then Ashwat Damodaran, he deeply explained about those factors. The identification of fundamental of determination of growth. These things he deeply explained about these things. Okay, but for the examination purpose, I think it is not needed to uh, know more about the these fundamental things. Okay, these are about the growth rate. Actually, as I told you, growth rate it is not important for your examination purpose, but I decided to do because I think understand about the determination of the growth rate. It is uh, more convenient for you to attend the examination questions. Okay, then this is about the growth rate. Then we can move on to the next most important part of next most important thing. It is about the identification of terminal value. Terminal value. Terminal value. Then what is the meaning of the terminal? Then here